In this video, I'll tell you exactly how reverse mortgages work, and we're starting right now. Hey guys, Elliot here. So one of the biggest financial issues for a sizable minority of American retirees is lack of any retirement savings. Back in 2018, a survey indicated that over 13% of all people over the age of 60 have zero in savings to fall back on once they stop working in their mid to late 60s. At the same time, over 80% of seniors own a home, usually with a major equity stake after years of paying off the mortgage. The convergent result of these two statistics is a population that is house rich and cash poor, with their entire net worth tied up in the value of their home. This situation is the reason for reverse mortgages, an industry that has risen in response to the less than desirable financial situation with US retirees. So what exactly is a reverse mortgage? Here's a simple and straightforward explanation. Since home equity is only useful if you borrow against it, a reverse mortgage is essentially a loan that allows homeowners over the age of 62 to convert a portion of their home equity into cash to live on or to supplement Social Security and other retirement income. A reverse mortgage is predicated on having sufficient available equity, usually over 50%, and wouldn't be possible if the homeowner just purchased a home with a small down payment. A reverse mortgage works by the lender appraising the property and issuing a loan to the homeowner that is equal to a portion of the available equity. The homeowner will then receive the cash in one of several ways, which I'll describe in a moment, with the interest on the loan rolled into the principal amount. No payments are taken from the borrower as they simply exchange their equity for the loan. As the years go by, the equity decreases in proportion to the principal amount plus interest disbursed. The lender is repaid when the homeowner dies and the property is sold, or the homeowner sells and moves out. During the life of the loan, the homeowner is responsible for all property taxes, homeowner's insurance, and upkeep of the property, and the home can be foreclosed on if these conditions aren't met. These are the basic rules of a reverse mortgage. If this all sounds a bit more involved than a simple home equity line of credit, that's because it is. Reverse mortgages are complex and specialized financial products with just a handful of qualified lenders available to originate and service these types of loans. Reverse mortgages have also, unfortunately, been a vehicle for unscrupulous lenders to perpetuate fraud, and I'll discuss some of the things to look out for later on. Despite the complexity and risks, over 32,000 reverse mortgages were issued in 2023, and if originated with a reputable lender, borrowers report a high level of satisfaction with the outcome. We have quite a bit more to go over, starting with the types of reverse mortgages available, so let's jump right in and cover all angles of this mortgage product. There are three types of reverse mortgages available. The first is the single-purpose reverse mortgage, or SPRM. This type of reverse mortgage may be used for only one purpose, which the lender specifies. For example, this can be used for home repairs, improvements, or property taxes. Most homeowners with low or moderate income can qualify for these loans, and they're offered by some states and local government agencies as well as nonprofit organizations, but they're not available everywhere. SPRMs are the least expensive of the reverse mortgages in terms of fees and interest, and they're also not as common. The second type is a proprietary reverse mortgage, or PRM. This is a reverse mortgage for higher valued homes, with 2023 cutoff being any property valued at $1.1 million. These jumbo reverse mortgages are not federally insured and have no mortgage insurance fees, but may have a higher interest rate to offset risk. They are also relatively rare. Finally, we have the home equity conversion mortgage, or HECM. This is by far the most common type of reverse mortgage and is generally what everyone in the industry refers to when a subject is discussed. HECM is a federally insured reverse mortgage backed by the U.S. Department of Housing and Urban Development, or HUD. It is the most widely used type because it carries no income limitations or medical requirements, and the loan can be used by the homeowner for any purpose. To qualify for HECM, borrowers must be at least 62 years of age and complete financial counseling before being approved. They must also live in the home, thus investment and vacation properties are not eligible, and must maintain the property in the condition it was in when the loan was approved. Also, the primary mortgage balance must be paid off with loan proceeds because the reverse mortgage can be the only lien on the property. Finally, all property taxes, homeowner's insurance, and any other fees and obligations must continue to be paid by the borrower homeowner. Next to discuss is how you would get your money. Reverse mortgage borrowers can choose how to receive their proceeds from 6 distinct options. The first is lump sum, where the borrower gets all the proceeds at once when the loan closes. This is the only option that comes with a fixed interest rate. The other 5 have adjustable interest rates. The second is term term payments, where the lender gives the borrower equal monthly payments for a set period of the borrower's choosing, typically for 10 years. The third is line of credit, where the money is available for the homeowner to borrow as needed. The homeowner only pays interest on the amount actually borrowed from the credit line, which is similar to a HELOC in this regard. The fourth is equal monthly payments, or in other words, an annuity. The lender will make steady payments while at least one borrower lives in a home as their primary residence. This is also known as a tenure plan. The fifth is equal monthly payments with a line of credit. Here the lender provides steady monthly payments while at least one borrower occupies the home as their primary residence. If the borrower needs money at any point, they can access the line of credit. And finally, the sixth is term payments with a line of credit. With this, the lender gives the borrower equal monthly payments for a set period of the borrower's choosing, typically for 10 years. If the borrower needs more money during or after the term, they can access the line of credit. Now, there are a number of upfront and ongoing costs that are associated with a reverse mortgage, including the interest rate charged on the loan. At the time of this filming, reverse mortgage interest rates have risen, ranging between 6.5% and 7.5%, depending on the lender. Many of the upfront fees, however, can be financed into the HECM loan, keeping initial out-of-pocket costs low, and here are some of the upfront fees to look out for. The first is lender origination fees. These fees compensate the lender for originating the loan. You'll pay a fee that's equal to either $2,500 or 2% of the first $200,000 of your home's appraised value, whichever is greater, and then 1% of your home's value above $200,000. This can be quite a bit, but fortunately the Federal Housing Administration mandates a $6,000 cap on these fees for HECMs. The second is closing costs. These include fees for an appraisal, title search, and inspection. Additionally, smaller charges may include a credit check, escrow services survey, and potentially flood certification fee and pest inspection, and you may be able to save on these costs by shopping around. The fourth is HECM counseling. Due to the complexity of reverse mortgages and the potential for fraud and abuse, you will be required to participate in a reverse mortgage counseling session with a nonprofit counseling agency approved by the U.S. Department of Housing and Urban Development. The counseling fee is typically $125 or more, but depending on your financial circumstances, the fee may be waived. And finally, the fifth cost is the upfront mortgage insurance. The FHA charges an upfront mortgage insurance premium, which is 2% of your home's value. For example, if your home is worth $400,000, your upfront MIP would cost $8,000. Now, these were the upfront costs, but there are other important ongoing costs of a reverse mortgage. First is the interest payments. Interest rates were mentioned earlier, and the more you borrow against your equity, the more you'll pay in interest. While you don't make any payments with a reverse mortgage, the interest will eat away at your equity and will be a factor when the loan is due. Next is the annual mortgage insurance. HECMs have annual mortgage insurance premiums equal to 0.5% of the outstanding loan amount. Since your reverse mortgage balance will grow over time, you can expect your annual MIP amount to increase as well. Third is property taxes. You're still responsible for annual property taxes, and this amount varies depending on where you live and your home's value. Finally, the fourth ongoing cost is the homeowner's insurance. You'll also need to maintain homeowner's insurance coverage and flood insurance if applicable. Your homeowner's insurance premium will vary depending on your location, the condition of your home, and other factors. In the United States, all FHA insured HECMs are non-recourse loans, meaning that borrowers are not responsible to repay any loan balance that exceeds the after-sale proceeds of their home. This simply means that you, as a homeowner borrower or your heirs, will not be responsible for any HECM loan amounts in excess of what the home is sold for on the market. Put another way, you can never be upside down on your HECM loan. The extra amount would be paid out by the FHA insurance that was purchased when the loan was originated. The loan will come due and will be payable if or when the last borrower or the non-borrower spouse dies, sells the house, or fails to live up to one of the loan terms. The borrower or their heirs can either pay off or refinance the loan to keep the home, or they can sell and settle the loan's balance, keeping any excess equity. So what are some of the pros and cons of a reverse mortgage? While overall HECMs produce a high satisfaction rate, they're not for everyone. Some of the pros include the following. 1. You keep your home and your name remains on the title. 2. You are protected from a declining home value because HECMs are non-recourse loans. 3. No restrictions govern the use of funds from a HECM loan. 4. Generally, no credit or income requirements prevent enrollment because the collateral is the home equity. 5. You don't make any payments outside of the costs and fees I discussed earlier. And finally, HECM loan proceeds are generally not considered taxable income, though you will definitely want to see a tax professional for more specific tax advice. Some of the cons include the following. The first is the fact that this is an uphill, not a downhill loan. In other words, the loan amount increases, not decreases over time as interest and fees accumulate. Second is that you are not leaving your home to any heirs free and clear. By using up all the equity, the lender will own the home after you die, leaving your your heirs without this asset unless they pay off the loan or refinance. And finally, you can lose your home if you fail to upkeep the property or make the required tax and insurance payments, and you can potentially outlive your HECM loan proceeds. So how do you apply for a HECM loan? There are 5 steps. The first is to pick a lender and discuss the specifics of your situation. Some well-known HECM lenders include American Advisors Group, Longbridge Financial, All Reverse Mortgage Inc., Finance of America Reverse, One Reverse Mortgage, Liberty Reverse Mortgage, and others. The second step is to provide all necessary paperwork. You will need to provide personal, income, credit, asset liabilities, and other information. The third step is to attend a Housing and Urban Development approved counseling session. As mandated by law, you must attend a third-party educational counseling session. This is to ensure you fully understand all the details of how HECMs work and your responsibilities. The fourth step is to go through a financial assessment. This is another hurdle to clear from the lender's side. They want to make sure that the numbers add up and that a HECM loan makes sense for you. Critical to the process is to demonstrate that you will have the ability to avoid defaulting on a loan by having the means to pay the required property tax, insurance, etc., as well as maintain the home or property or pay someone to do it. The fifth step is to do an appraisal, closing, and payment. This final step is an appraisal to determine the fair market value of your home and establish how much you can receive. Then the loan can be closed with assistance from a title agent or attorney. After closing, you will have a 3-day time frame called the right of rescission, during which time you can cancel a HECM loan with no penalty. If you proceed forward, the money will be dispersed according to the loan agreement. Now, as we close out the video on reverse mortgages, it's very important to mention the dark side to these products. Since HECM recipients, by definition, are seniors aged 62 and above who are already common targets of scams and fraud, this type of loan has seen a disproportionate share of such crimes. 3 possible issues that the industry warns about are contractor loans, veteran loans, and financial advisor sales. Contractor loans is when the contractors will try to convince you to get a reverse mortgage when advertising home improvement services. These are separate services and you should only talk to a qualified lender about reverse mortgages. Veteran loans are when you see ads promising special deals for veterans such as fee-free reverse mortgage to attract borrowers. However, the Department of Veterans Affairs does not have reverse mortgages and this may be fraudulent or against your best interests. Finally, watch out for financial planner or investment advisor sales. In this case, an unscrupulous advisor or financial planner may try to sell you a reverse mortgage. While this may not necessarily be fraudulent, it may also not be in your best interest. Only speak to a verified, top-rated HECM lenders about a reverse mortgage. Okay, that was a fairly in-depth explanation of reverse mortgages. As always, if you enjoy this content, please do like and subscribe, and I'll see you in the next video.